Hey, what's up guys? John here. The average monthly payment on a single family home in America is now $2,900 per month, and the average rental rate is now $1,900 per month. It costs $1,000 more every single month to own a single family home than it does to rent one. But things are going to get very, very interesting, as that cost to own a property is likely going to go from $2,900 to $3,400 to $3,500 in 2024, and the price to rent is very likely going to go from $1,900 closer to $1,500. Here's how it all breaks down. Here's what's happening behind the scenes. It's shocking. I think it's going to present a massive opportunity to invest in real estate, a massive, massive change in pricing of these homes. Multifamily properties is coming, and it's going to come like a storm, a level 5 storm in America. Please hit the like button. YouTube's going to share this content, educate more people about what's really going on. And if you want to fix your credit to position yourself for the greatest real estate wealth transfer of all time, go to greatcreditfast.com if you have bad credit or average credit. The average credit is a 698 in America. 698. You want to have a 770 to 800 credit score, 770, 780, in that range. You're going to want excellent credit to be able to get funding and financing to pick up some great deals. Go to greatcreditfast.com, click the link below, schedule a free strategy session. Take a look at this. So it now costs $1,000 more per month to buy a home than to rent. Meanwhile, the average car payment is $750 a month. The average interest rate on a used car just hit a record 14%, all while credit card debt hit $1 trillion for the first time with record interest rates of 25%, while Forbes is saying 28%. Basic necessities are becoming unaffordable for Americans. Well, housing market affordability has been hitting new lows almost daily for over a year. Simply waiting for conditions to improve may take years. Well, look at this. In 2008, many people think that buying rental properties is a great hedge during recession, because what ultimately happens is people, they move from losing their homes into apartments, and people have to downsize. And so for multifamily operators, people that own rentals, if you own studios and 1 bedrooms and 2 bedrooms, you start to see a lot more demand, and because of that, prices actually increase. And I've heard rumors of people saying, no, in 2008, 2009, 2010, when the market fell apart, rents actually increased. Well, actually, the complete opposite. According to MPF research, nominal rents for large investment-grade apartment properties slipped 0.3% in 2008, then dropped 4.1% in 2009. Pretty big decline, considering the fact that most investors buy these deals at a 5% return, between 4 and 6%. So when you see rents fall 4.1% plus 0.3%, it's a big problem for a lot of these operators. So when we look at what's happening now, apartment rents are now 1.2% cheaper than a year ago. This came out 20 hours ago. So last year, in many areas, whether you're in St. Pete Beach, whether you are in Tampa or Miami, you're seeing 20, 30% rent bumps. For landlords, that's a great thing. So a lot of these landlords nationwide have been anticipating that rents are going to continue to likely increase, but now the complete opposite is starting to happen. And I think it's going to get much, much more interesting when we start to see these other variables step into play, and so much more rental inventory hits the market, and this affordability crisis gets so much worse, where this small home inventory that's available now, where a lot of home sellers think, hey, I'm on the driver's seat, I have a 3% mortgage, 4% mortgage, 2.5% mortgage, I'll sell if I want to sell, and I don't really think I need to sell, so I'm just going to keep on this, or keep this free money loan, 2-3% mortgage. It's basically free money. I'm just going to keep it, and I'll pay off this property. The average person stays in their home 7 years. Most people bought homes in 2020, 2021. So before you know it, you're going to start seeing people that naturally want to move. You're going to start seeing the job market likely change. You're going to start seeing this affordability crisis get worse, and people are going to look to save money. That's what's going to happen. And as that's happening, U.S. apartment construction could hit a 50-year high, but housing shortage continues. So think about this for a second. If rents are already $1,000 cheaper than owning, and you have apartment construction hitting a 50-year high, all this inventory is going to start to come onto the market. Naturally, rents are going to continue to slip. And so if rents are continuing to come down and people are struggling to pay their bills, what are they going to do? They're going to do what they have to do to survive. They're going to likely sell their properties, rent out their homes, give the keys back to the bank if they have no choice. If they have no choice. And I think a lot of people are going to have that situation, because a lot of people are underwater on their properties. And so when you look at this scenario, it paints a picture that this payment, the monthly payment, is likely going to get worse when we look at what the Fed said. Fed sees a 40% chance of meaningfully higher interest rates. Jamie Dimon warns Fed funds rate could be 7%, meaning mortgage rates will be closer to 10%. So if you think about this, if you're an investor, you might say, well, why would I buy a house when rents are so much cheaper? Well, look at it this way. Who would buy homes at these prices? $500,000 property, 30 grand down, 6%, 8.5% mortgage. If they continue to increase interest rates, which they see as very likely, and I personally think they're probably going to hit one more rate hike this year, maybe one or two next year. But to see interest rates around 8.5%, we're already close to 8% right now if you have perfect credit. So 8.5%, I mean, you're looking at $4,400 a month. Let's say, for some people say, John, you're being extreme. It's never going to get to 8.5%. Maybe it's just going to stay at 8%. Okay, $4,235. Who is going to buy a house and spend $4,235 per month, put $30,000 down, and deal with the rising insurance and taxes, rising cost to service, maintain, and fix the property, when they could rent something and save $2,200 a month, right? Not many people are going to do that. But if you start seeing a lot of sellers start to come into the market, and it's not going to take a ton. There's only 600,000 homes for sale in the market. If you see 100,000 homes, 150,000 homes come on the market, they're chasing a small pool of buyers, meaning that the sellers are now going to be competing to get the attention of the buyer. And how are they going to be doing that? By decreasing their prices. And how are they going to be doing that? Well, they're going to be doing that based on their ability to decrease their prices. You might see banks start to take a lot of inventory and start trying to offload it, likely to large institutional investors, private equity firms, and things of that nature. There's going to be a lot of opportunity to invest, but when you just start to look at these dynamics, these numbers, people think, oh no, rents are only going to go up and home prices are not going to come down. Who do you know that can comfortably afford to spend $4,200 a month on a mortgage? Not many people. I would bet of the 10 people you know, maybe 7 or 8 of them could not afford that, right? So only 1 or 2 probably could. So you look at this dynamic that we're in right now. Home prices are already coming down, and they're really going to start coming down. Austin, Texas, already seeing it happen. From the peak 2021, housing prices have cooled a bit. Recent listings, more price cuts than ever. Over 25% of listed homes have dropped prices to attract buyers. Phoenix, Arizona was the poster child for real estate boom and bust. Back in 2008, during the Great Recession, housing values dropped over 50%. Well, now there's a possibility of a large decline in housing prices. Goldman Sachs predicts 25% home value drop in the economy, largely due to overinflated current market prices. Seattle, Washington. If you look at this, Seattle home prices have grown exponentially compared to many cities, with median home prices nearly $900,000 in 2022. But raising rates and inflation have squashed demand, and median home prices dropped significantly, coming down around $800,000, $100,000 reduction, right? St. Augustine, Florida, same thing. Over 28% of listings have now dropped prices. Vegas, $500,000 on home prices in 2022, now $395,000. So you're getting the trend. The trend is that we're going to see very, very, very limited buyers out there. And you're going to start to see sellers that bought a property that can't afford the insurance and taxes and everything as this job market continues to pull back, inflation gets worse, and the Fed continues to keep rates higher for longer. And so when you're looking at this and you see rents at $1,500, $1,600, $1,700, when you see all this rental inventory at the market, how many people are going to opt in for owning a property during these uncertain, scary times? Not that many, right? But the real money is made when the masses are afraid. And I think that a lot of the masses, I think the majority of the people are going to start to get really, really concerned over the next year or so. And so that's the moment that you're looking for a really, really good deal. The really good way to look at this is you look at real estate the way in which Blackstone and a lot of these large private equity investors look at it. They do something called a discount to replacement value. And so what this means is if they were to buy, let's just call it a single-family home. Single-family home, the land is worth, say, $100,000. And maybe it's a 2,000 square foot house, and just for easy math, $100 a foot to build. Now, of course, it's going to be $250 a foot or more, but just for easy math, say it's 2,000 square foot house, $100 a foot, that's $200,000 to build the structure. The land's worth $100,000. All in, you could replace the property for $300,000. They do a discount to replacement model, meaning that they'll say, hey, if I can buy it for 50 cents on the dollar for this $300,000 evaluation, and I can pay $150K, I'll buy it. And so what they do is they buy it knowing that the real investment is the land. The real investment is knowing that a competitor can't come out and underprice them. And so what they do is they buy all these deals based on this really strong formula. And then they have the rent demand to support the asset. And if rents go up or down 15 or 20%, they don't really care because A, they're putting a lot of money down, and B, they bought it well from the get-go. But when you look at the situation that we were in the last couple of years, people would buy a house, a completely flipped property, it felt like brand new, but they bought it for top dollar to where, maybe they could replace the property for 600 grand or 500 grand, but, the new investor, the new person that bought that property paid 900. They're in big trouble. So if you have the right formula, the right strategy, you know what you're doing, you have cash, you have great credit, you make a fortune, right? But the fundamentals are here. Rents are going down and property values are going down. What do you think about this? Drop below, hit the like button, add me on IG. If you want to fix your credit, we'd love to help you. We really would. At my company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, any negative item holding you back from getting great credit, go to GreatCreditFast.com so you can get funding and financing, position yourself for the best possible loan for what I think is going to be the greatest wealth transfer in American history. See you guys in the next video.